Efforts are underway to keep the floundering Egyptian pound stable against the dollar. This week, private bank Baraka issued attractive 12.5% interest rate certificates, the highest in the market, but on one condition: you have to exchange dollars to pounds at the bank, and this money only will cover the certificate. The aim was to increase the supply of dollars and the demand for the local currency. The government intervened early this month to control the pound slide. It pumped $8 billion in the market for businesses. It also allowed state-owned banks to issue 5-year certificates with 10.5%, 2% above market levels. Banks gathered $10 billion in a week, while the pound rebounded by 15%. But some businessmen are skeptical.
Now, for a lot of economists, this is not the right way to go about it. If we are looking in Egypt to have a free market economy with a liberal fiscal policy that really invigorates the attraction of international and foreign investment, and as well invigorate the domestic sector, we need to be looking at reducing some of our interest rates, not only in banks, but also for us to be able to reduce some of the tax rates as well.
These are apparent policies of the newly appointed central bank governor Tariq Amir. He's known to be more aggressive than his predecessor. Sources expect state banks will issue dollars to pound-related certificates similar to Al Baraka's, with interest rates that could exceed even 14%.
I think the central bank governor is doing a good job. Direct intervention to control prices will not work because the dollar itself is like a product controlled by the forces of supply and demand. The central bank mechanisms, however, are indirect intervention. It will encourage savings in Egyptian pounds, which will stop the meteoric rise of the dollar.
The central bank is trying to make up for the dwindling income and foreign reserves of the last 4 years. Recent efforts can place a lid on the surging dollar, but it's all temporary. The real cure to the monetary crisis is to create sustainable hard currency revenues from sectors such as tourism, exports and FDIs. Yasser Hakim for CCTV, Cairo.